All right. I'd like to take this opportunity and to discuss equity valuation. All right. And some of you may remember in your Finance 201 or Finance 310, you have touched upon equity valuation. All right. So, uh, you know, uh, those are, very important discussions, and our discussions here builds upon, those, discussions in those classes. All right. And, the primary approach is still discounted cash flow. All right. But before I move on to the details of equity valuation, I'd like to provide you with a little overview of equity valuation. Okay. Well, first of all, we know that stock prices are very hard to predict. Okay, so equity valuation is very hard. All right, very hard to do. Okay, and if you are really good at it, you can actually make a very good career out of it. All right. For example, some of you are going to work as security analyst for investment banks. All right, and one of your primary duties is to cover the stocks in a particular industry, maybe a few leading stocks or major stocks in the industry, and provide, for instance, your clients with the targeted price. Okay, and of course your recommendations. All right, sometimes your clients subscribe to your research report, and in the report you recommend whether you should buy or hold or sell the stock. Okay, so that is apparently very interesting, but also very challenging. All right, and some people say stock prices follow a random walk. Okay, indeed, if you look at what is a random walk, well, a random walk is a very important statistical concept. All right, maybe the simplest way to understand this is that you think of a drunk man. Somehow this drunk man is actually standing in the middle of the of a big field, or like a soccer field or football field, and you draw a circle. The center of the circle is this drunk man, and you're trying to predict at what direction he's going to make the make the next move, and in what how large is his step size. All right, so this is very hard to predict. Okay, some people say the weather in London is hard to predict, and yet the stock prices are just as difficult to predict as the weather in London. All right, so does that mean we should actually wrap up and go home and call it a day? Well, apparently, we still want to tackle this important task because it's actually so important. All right. Um, you know, so there are still valuation models for us to for us to learn from. All right. In the real world, as a real-time security analyst, you are more or less implementing these different models. All right, and so you have to actually watch out the conditions, okay, under which these models apply. All right, in other words, the assumptions, okay, and also the limitations of various models. Okay, your firm may actually have their own proprietary valuation models. Okay, maybe your valuation team is actually used to making certain assumptions, and they think these assumptions can actually, for instance, suit the the company very well. All right, so if you look at the the models, we have essentially different kinds of models here. The first one is the so-called present value of cash flow model, and I'm looking at the lecture note here now. All right, so please have the lecture note by your side, and it's very easy for you to make a reference. All right, present value of cash flow models. All right, so this actually includes the dividend discounted model. All right, dividend, I should probably use the full name here, discounted model, okay, the so-called DDM, and the free cash flows valuation approach. Free cash flows valuation approach, okay. All right, so there are two kinds of free cash flows. One is called free cash flow to the firm. One is called free cash flow to equity holders. Okay, don't worry about this. We're going to discuss them in great detail later on. All right, so these are alternative models, based on the present value of the cash flows. Again, the methodology is you have to discount the cash flows from the equities and get the present value of these cash flows. Okay, and there's another kind of valuation approach which is actually based on the multiples of comparable firms. Okay, so this is actually very, very easy for you to understand. So basically, you're looking at the firm you're trying to value, and you're trying to find some other firms that are actually comparable. Okay, some other stocks that are similar. All right, and you actually use the valuation ratios from the other stocks, to measure or to value the stocks you're trying to value. Okay, so in this regard, we have the PE ratio. Okay, price to earnings per share, and you can also have the price, cash flow ratio, and also the price to book value ratio, and etc. Okay, so these are another kind of valuation models. All right, as I said, you have to watch out the conditions or the assumptions and the limitations of all these different models. All right. In the real world, if you want to do a really good job, you may have to actually apply or plug in all these different models and see how different your valuation numbers are. All right, and so that is another reason. Oh, by the way, I almost forgot. Another reason why the equity valuation is so hard is you can actually compare equity valuation to bond valuation. All right, so if you look at bond valuation, well, I'm sure you guys have discussed the bond valuation in Finance 201 and 310. All right, so you look at the coupon cash flows, you discount them at the yield to maturity, and then you get the present value of all the future cash flows, and you get the bond price. Okay, so when you do that, in many cases, the cash flow amount and the cash flow timing is actually known for sure. Because the bond may actually, let's say, have a 6% coupon. It's going to mature in 20 years. All right, so you're going to receive 40 coupon payments if the bond is actually paying semi-annual coupons. And when the bond matures, you're going to receive the face value. All right, so the cash flow amount, cash flow timing, these are actually known information. Okay, but if you look at equities, does the stock pay dividends? Well, that is not certain. All right, that actually is entirely up to the board of directors. Okay, and what is the appropriate discount rate for you to use to discount those dividends? Well, that's actually quite elusive as well. So this is another reason why equity valuation could be very challenging. All right, so let me actually go ahead with the first a major valuation approach. Is called the dividend discounted model. Okay, and I'm going to actually look at, first of all, the general dividend discounted model. All right, so the general dividend discounted model says if I want to value stock price today, I should look forward. In other words, I should look at the dividends that will be paid out by this particular stock. Okay, and I'm just copy this valuation equation from my lecture notes. All right, let's see whether I can, yes. All right, so I can actually paste this equation here. So P0 is the stock price today. The D's are the dividends in the future periods. And the R is the investor's required rate of return. All right, so these are the notations and their meanings. All right, so look at this. You clearly see that stock price today is the present value of the first dividend. Okay, so that's given by D1 over 1 plus R, plus the present value of the second dividend, which is D2 over 1 plus R squared. All right, and so on and so forth. Okay, so apparently there's a problem for this general dividend discount model. All right, the problem is this model is not operational because it has infinite number of periods. Okay, so standing at today, if you ask me, why Tesla is actually selling for, let's say, $700 at this point. All right. If I want to actually find a solution, if I want to answer this question from this dividend discount model perspective, then my answer is that's because we believe the present value of all future Tesla dividends, after appropriate discounting, they will add up to $700. Okay, so of course this answer is really not telling you that much. All right, but it does show that the stock price today is the present value of all future dividends. Okay, maybe I should actually recap this one here. The stock price today is the present value of all, I should really emphasize, future dividends. Okay, so if you want to get a stock price in period 0, you look forward. All right, this is the so-called forward-looking nature. All right, you look forward, you look at D1, D2, and so on and so forth. So if you want to get a stock price in year 5, you look at dividends starting from year 6 and onwards. Okay, forward-looking. All right, so this is a very important nature of this dividend discount model. All right. And because this, infinite horizon, this model is not operational. You cannot crunch the numbers out of this model here. All right. So what we can do instead is we're going to look at, some, structure or some, assumption imposed on the dividends. Okay. And that will actually bring us to the constant dividend growth model. Okay, so this is also known as the Gordon model because Myron Gordon was the first person to propose this model, right? Myron Gordon was a finance professor from University of Toronto, all right? I believe this model was actually first proposed back in the 1960s, okay? So this is now imposing some structure on the dividends, all right? Because if you just talk about infinite number of periods in the future, well, it's not operational because you're dealing with a mathematical series, okay? So I'm going to look at the assumption here. The assumption is very simple. We just assume stock dividend grows at a constant growth rate of G, all right? So I'm just going to denote this growth rate by G, G for growth, okay? So this is a very interesting assumption. I should say this is a very unrealistic assumption because you're always assuming that it doesn't matter how far you're looking into the future, the stock dividends are constantly growing at this rate of G. Okay, so you may ask me, are the companies able to do that? All right, maybe there are some good years, there are some bad years, there are some financial crisis periods. So maybe the firm is actually going to cut dividends, okay? Maybe there's going to be, economic expansion. Firms are doing extremely well, so the firm may actually pay more dividends. So, there's a question as to whether whether this company will be able to, or whether the companies are willing to maintain a constant dividend growth rate. All right, but if you're willing to pay this price, if you're willing to make this assumption, then the conclusion is actually very straightforward. The conclusion says, or Professor Myron Gordon shows you that, hey, if you want to get a stock price, if you are willing to pay this big price of constant dividend growth rate, well, the stock price today, P0, is equal to D1 over R minus G. All right, so D1 is the next period of dividends. Okay, R is investors' required rate of return. All right, G, well, G is the constant dividend growth rate. Okay, so that's the assumption. All right, so the Gordon model says if you want to value stock price today, for any given stock, all right, as long as the stock is expected to pay dividends in the future, how do you know that? Well, maybe the firm actually paid the dividends in the past. All right, so as long as you think the firm is going to pay dividends in the future and the firm is actually going to maintain a constant dividend growth rate, all you need to value stock today is three quantities. Number one, the next period of dividend. Okay, of course, you put down your best to estimate. And number two, the investor's required rate of return. And number three, the constant dividend growth rate. All right, so that is, apparently way too simplified. All right, but nonetheless, we're going to actually use Walgreen as one example. All right, so to implement the Gordon model. Okay, so I'm going to actually use Walgreen to actually implement this Gordon model. So let me just get the estimates here. All right, so to get the three inputs. All right, so I need to get the three inputs so that I can actually plug in, these inputs into this valuation equation, and spit out the stock price. Okay, so input number one. All right, what is the G here? Okay, the constant dividend growth rate. All right, so how do we estimate G? Okay, so method one. All right, look at the past dividend history. Okay, so you can actually look at the past dividend history, and you can actually try to get the dividend the growth rate estimate. All right, so speaking of that, please go to equity valuation Excel spreadsheet, and because I'm using TechSmith Relay to make this video lecture. So it's not easy for me to actually switch back and forth between different screens. Okay, so please go to the equity valuation Excel spreadsheet. All right, and from that spreadsheet, we know we're looking at the first tab, which is actually labeled as WAG dividends. Okay, Walgreen dividends. All right. So let's just browse the data here for a second. All right, if I'll pause here for a few seconds. Just make sure you guys actually find this Excel spreadsheet for equity valuation. Okay, all the Excel spreadsheets are actually posted on Blackboard, and you can actually download all of them and put them in the folder for this class. Okay, so assuming you are able to find this data here, then we see that this actually compiles the dividend history from Walgreen all the way back to 2001. All right, and if you are wondering where do you get this data, well, you can actually get this data from, let's say, Yahoo Finance. Okay, I can actually show you. If you're interested, I can actually show you how you can actually download the dividend history for any company as long as Yahoo Finance has it. All right. So we know in this, history data that in 2001, actually, in February the 14th of 2001, Walgreen paid 3.5 cents per share dividends. Okay. So I'm just going to put this down here. Dividend in 2001. All right. And Walgreen actually paid, quarterly dividends. Okay, as you can see from the first column here, It was February, May, August, November. So yes, it's quarterly dividends. All right. And so I'm just going to do a very simple algebra here. 3.5 cents per share dividend, and they paid 4 quarterly dividends in a year. So I can just multiply that by 4. So that's about 14 cents per share per year. Okay, in 2001. All right. So that's going to be our starting point for the dividend. Okay. So now let's look at the more recent dividend history, which is actually 2010 for Walgreens. All right, as you can see, indeed, Walgreens is growing dividends over time. All right, so in 2010, the most recent observation we have is 13.8 cents per share. So again, I'm going to do 13.8 cents per share. This is 1 quarter. We have 4 quarters. So that's going to be 55.20 cents per share. Per year. All right. So now we actually have a starting dividend, 14 cents per share. And then we have an ending dividend, which is actually 55.20 cents per share. Okay. And it takes, 10 years, to, go from, 14 cents to 55 cents. Okay. So what's the growth rate? Okay. What's the growth rate? All right. So, well, in this case, I can actually use the rate function to calculate, what is the growth rate. So in this case, I can interpret the 14 cents as the present value, the 55.20 as the future value, and I know it takes me 10 years. All right, so I can actually calculate the speed at which the dividend grows. All right, so I can actually use the rate function here. It takes me 10 years, and there's no other cash flows in between. It's just a single cash flow here. Present value is negative 14. Future value is positive 55.20. All right, so if I do algebra, that's going to show up as 14.70. All right, and now I can actually say, hey, this is one of my estimates for G. All right, so this is 14.70. Okay, and method 2, there's another way for you to actually get the dividend growth rate. All right, so let's get back to the Excel spreadsheet for this equity valuation chapter. And also on your lecture note, that there's an equation called the dividend growth rate is going to be equal to something called RR times ROE. All right, so what is RR? RR is the retention ratio. Okay, what is the retention ratio? So let's say the firm actually have $1 earnings per share, and the firm is actually deciding to pay out 60 cents as dividends and keep the rest of 40 cents as the retained earnings. Okay, I'm talking about accounting terms here. If that's the case, then the dividend payout ratio is going to be 60%. The retention ratio is going to be 40%, or 1 minus the 60%. Okay. All right, so this is essentially, retained earnings, over earnings per share. Okay. All right, so that's the retention ratio. And ROE, well, you guys know what is ROE from your Finance 201. This is return on equity. All right. So if you want to get your dividend growth rate, you can actually multiply the RR, by ROE. Okay. So let me get back to the Excel spreadsheet. We're looking at the past 10 years for Walgreens, and in column B we have the retention ratio, and in column C we have the return on equity. Okay, and by the way, this is the second tab of this Excel spreadsheet for equity valuation. All right, the first tab is for or the first worksheet is for Walgreens dividends. The second one is what we're talking about here. This is the retention ratio and ROE data. All right, so I can actually look at the dividend growth rate for each of the years, and I can then take the average. And if I do that, the average is going to be, all right, so if I take the average is going to be, averaged across the past 10 years, and that's going to be 13.70%. Okay? And you do notice that in 2009 and 2010, from this, past, retention ratio data and return on equity data, this most recent 2 years, the retention ratio is actually going down. All right, it used to be above 80%, all right, around 84, 85. But then for the most recent 2 years, the retention ratio actually, drops, below 80%. Okay, so retention ratio is going down. Now, if you look at the return on equity is also going down. All right, it used to be above, 16 or even 17%. But in the most recent 2 years, the return on equity is actually around 13, 14%. Okay, so these most recent 2 years are a little fresher, so I might want to actually give them a bit more weight. Okay, so having that in mind, all right. So to be conservative, okay, to be on the safe side, we take G to be 13%. Okay. All right. So you have to estimate. One is 14.70. One is 13.70. All right. But we have a little observation for the retention ratio and the return on equity in the most recent 2 years. So I'm actually doing a little fine adjustment. All right. Again, that takes many years of experience to do so. All right. So here I'm just using this as a little illustration. When you value equity, in most cases it's more like art than science. So you have to actually pay attention to all these little adjustments over the course of this this process. Okay. All right. So that's input number one. We have G to be 13%. All right. Now input number two. Okay. Well, the most recent, the next dividend. All right. So D1. All right. So now we're trying to value Walgreen at the end of 2010. All right. So to value Walgreen at the end of 2010. So dividend, D1 would be dividend in 2011. All right. So how do we get this estimate? All right. So D1, that's going to be equal to the previous dividend, which is the dividend in 2010, which is this number here, multiplied by 1 plus the growth rate. And we're saying we take 13% to be the dividend growth rate because we have considered both the the dividend growth rate from the past dividend history and also the multiplication by retention ratio and return on equity, and we take growth rate to be 13%. All right, so that's going to be 62 cents per share by the end of 2011. All right, so that's my input number two. All right, input number three. What is R here? Required rate of return. So what is that? Can we build an estimate for this? All right, so this is another place where we need to actually refer back to Finance 201. All right, in that clause, you have dealt with something called a CAPM. Okay, as I'm typing down the name here, you start to what we call this is the capital asset pricing model. All right, the capital asset pricing model says expect return on any stock I. All right, on any stock I is equal to, all right, expect return on any stock I is equal to risk-free rate plus a risk premium. Okay, and risk premium is actually having two parts. One is the beta for stock I. Okay, beta for stock I times the market risk premium, and the market risk premium is the expect return on the market portfolio minus risk-free rate. Okay, All right, so we're going to actually, implement this CAPM here and build up an estimate for investors' required rate of return, because if investors' expected rate of return is going to, is going to be, for instance, what they require when they invest in Walgreens. Okay, all right. So now we need, a few more things. Need risk-free rate. Okay. So if you look at the lecture note, we actually have the risk-free rate around that time period. And if you just, plug in the numbers, risk-free rate, around that time, it's about 3.5%. Okay. So let me just put down this, 3.5% here. All right. And how do you come up with this, information? Well, you can actually look at, for instance, the yield on T-bills. For instance, the yield on 1-year T-bills. Okay. So around that time, that was 3.5%. All right. And we also need to have market risk premium. All right. So what is the market risk premium? Or in other words, what is the expected return on the market portfolio? All right. Because once you have the expected return on a market portfolio, you can actually subtract 3.5% from that, and you would get the market risk premium. Okay, so this is highly controversial. All right, so what you can do is actually you can actually look up for instance different sources where people may actually make their assumptions about market risk premium. Okay, and this could range from 3% to 8%. All right, market risk premium. Okay, so here we're going to make a call, and we take it to be, all right, we take it to be, what do you want to use here? All right, so we take it to be 4%. Okay, so again, this is arbitrary. All right, you may have to justify why you think 4% is actually more plausible. All right, because we're saying the rate, the range typically is from 3 to 8. So you're taking 4, that's actually towards the lower end of this, interval. All right, so you may have to find a way to justify that. All right, again, that takes many years of experience. Okay, and you may have to fine tune this. All right, so now the next question is beta for Walgreens. All right, so where can you get beta for Walgreens? All right, so you can actually method 1, you can actually pull up pull up, from Yahoo Finance, let's say, all right, or Capital IQ or Bloomberg, all right. I strongly encourage you to actually look up, information about, beta and other financial, financials, from these, information sources, okay. That is apparently relying on Yahoo Finance, and you can also estimate your own beta for Walgreens. Okay, so if you want to actually estimate your own beta for Walgreens, you would have to actually, you can actually do a little regression. Okay, so I'm just going to, so how do I do this? All right, I have the third tab from the Excel spreadsheet for equity valuation. All right, so please, look at the third, tab here, or the third worksheet from this Excel spreadsheet for equity valuation. Okay, so if you want to actually estimate your own Walgreens beta, what you can do is actually in column A, you look up the past 5 years. All right, monthly returns on Walgreens and on S&P 500. Okay, so we're using S&P 500 as a proxy for the market portfolio. All right, so now you have 3 columns. Column A, well, these are the past 16 months. All right, so you look at this. This is a monthly observation. So you're looking at 5 years times 12 months per year. You're looking at 60 monthly observations. All right, in second column, you have the Walgreens return. And in the third column, you have the S&P 500 return. So now you can actually, column, I should say column 1, monthly dates. Okay, in column 2, you have return on Walgreen. Okay, and column 3, you have return on S&P 500. All right, so now you can actually run the little regression. Okay, so there are many different ways for you to do the regression. So I'm going to revert back to the Excel spreadsheet for equity valuation. All right, so you can actually use the data analysis toolpad. All right, so let me just show you briefly where. Well, I can show you now because everything is actually in the Excel spreadsheet. I don't think I can actually go back and forth between different screens when I use TechSmith Relay. All right, so I think I'm just going to make another short video on running regressions. Okay, this way I can actually address the the issue. All right, so let me just check out the separate the short video on running regressions in Excel. Okay, all right, so that will fix the problem. All right, so we have the information available, and assuming we can actually run the regression, and then we can actually put our estimate here. So in this case, beta is actually 0.96. Okay, so beta for Walgreen. Beta for Walgreen here is 0.96. All right, so now putting all this together, all right, according to CAPM, what do we have? So we have investors' required return, required rate of return on Walgreen is now equal to risk-free rate, which is a 3.5, plus the beta, which is 0.96, times the market risk premium, which is the 4%. Okay, so this is actually 7.34%, and we're going to again make a little adjustment, and we adjust it upward to, let's say, 8%. Okay, again, this is arbitrary. All right, so you may ask me, why do you round up to 8%? Why don't you just round down to 7? Well, remember, this is arbitrary. All right, but I may have a little justification for that. Remember, when we discuss the market risk premium, we say it can range from 3 to 8, and we take this market risk premium to be 4. So if 4 is somewhat a little low, then now here we're actually trying to make up for it. All right, so that's why we're going from 7.34 to 8%. Okay, now putting together, all right, what do we have? All right, so we have the Gordon model. The Gordon model says Walgreen price at the end of 2010. All right, according to the Gordon model, this is equal to, all right, D1, which is the 62.38, divided by R. R is 8%, investors' required rate of return, minus the constant Walgreen dividend growth rate, which is actually G, which is 13%. Okay, so now you actually have the Gordon model, and the number is actually negative. This is apparently nonsense. Okay, the stock price cannot be negative, right? So if you ever see a negative stock price, well, let me know. I can bet my entire fortune on it. All right, so what's the problem? Okay, what's the problem of our exercise when we implement the Gordon model? Well, the problem is apparently caused by the constant dividend growth rate of 13%. Okay, so in this case, the investors' required return is actually only 8%, and the dividend is actually growing at 13%. Okay, so when R is less than G, the stock price actually, turns out to be infinitely large. All right, so the stock price is going to be explosive. It's going to be infinitely large, and nobody is, is able to afford one share. Not, Jeff Bezos, not Bill Gates, not Elon Musk, and so on and so forth. All right, so the stock price is just too expensive. It's actually infinitely large. All right, so the question is, how do we, salvage, or how do we save our, valuation exercise? Okay, so how do we actually, can we still get something out of this exercise here? All right, so that is, bringing us to the next, dividend, discounted model, which is actually the non-constant dividend growth model. All right, so non-constant dividend growth model. Okay, so now we're actually going to move away from the constant dividend growth model because we know that is problematic. Okay, we just run into a negative stock price. All right, so now we're going to actually move on to non-constant dividend growth model here for Walgreens, and apparently we're going to assume the Walgreens dividend, all right, has the following, growth pattern. Okay. All right, so we're going to actually, move away from the constant dividend growth model, and we're going to move into a non-constant dividend growth model. So now the question is, there are just so many modeling assumptions you can make when it comes to non-constant dividend growth model. All right, so how do you do that? Okay, so I'm going to actually copy and paste this input from the Excel spreadsheet for equity valuation here. All right, I don't like the gray, so let me just format the shape, and let me just use a different field color here. So how about we use green here? All right. Okay, so now we're going to say the dividend growth for Walgreens is going to follow 3 stages. All right, stage number 1, well, it's going to grow at 13% as you just calculated. All right, so maybe the Walgreens dividend actually maintains some kind of momentum, so it's going to actually be able to grow at 13%. All right, so that is the first stage. And in the second stage, well, the dividend growth rate is going to slow down. All right, and if you do not like a sudden slowdown, we can actually take a a gradual slowdown. All right, so every year the dividend growth rate is going to slow down by 1%. All right, so it goes from 13 to 12 to 11 to 10, and so on and so forth. The question is, when does the growth rate stabilize? All right, so now the third stage is the constant dividend growth rate period, and we just say Walgreens is able to or is willing to maintain a 6% constant growth rate, after the first 2 stages. All right, so if that's the case, I can actually look at year. I can actually build a timeline here, 2010, and that's going to be my period 0. Okay, and 2011, that's going to be my period of 1. All right, so I'm doing a timeline here now. All right, so 2011, that's going to be my period of 1, and well, theoretically speaking, when we need to value equities by doing the dividend discounted model, we should consider all the future dividends. All right, so really we should have an infinite horizon here. That's actually indicated by the 3 dots. Okay, so apparently we need to find a way to cut the timeline. All right, because if you are actually carrying this infinite horizon, then this is not operational. All right, so period 0 is for 2010, period 1 is for 2011, and so on and so forth. Okay, so let's look at again, this is infinite horizon here, and now let's look at the dividend per period. Okay, so we're going to actually start to work on this timeline here, and we know that the dividend today is 0.552. Okay, remember that's the number we had earlier by looking at the past dividend history from Walgreens maybe we downloaded the data from Yahoo Finance. All right, so that's 55.20 cents per share. And then we're saying the growth rate, dividend growth rate per period. Okay, so now we're saying, well, initially we take that to be 13% forever, and that is problematic. So now we're actually breaking this into 3 stages. In the first stage, it's going to go at 13% for 3 years. All right, so that's going to be for year 2011, 12, and 13. All right, so if you want, you can actually merge and decenter these cells. And where can I find it? All right, so whoops, I think that's the button here, merge and center. Okay, so this is actually stage 1. All right, so in stage 1, Walgreen is actually going to go at 13% for 3 years, and then it's going to slow down at 1% per year. So I know starting from year 4, its growth rate is going to be 1% less. So that's going to be 12, and then it keeps slowing down. So that's 11, 10, 9, 8, 7. Okay, so that's the second stage. All right, so if I want, I can actually say this is stage 2. All right, and I can actually put this in bold as well. And then it's going to stay at 7% there forever. All right, so that is the third stage, and that is the constant. Okay, that is the third stage. All right, and this is the stage 3. Okay, the constant dividend growth rate stage. All right, so we just replaced our constant 13% growth rate with this 3-stage growth pattern. Okay, so what should we do now? All right, so the methodology here is very straightforward. I have the dividend for 2010, and I have the dividend growth rate for the future years. So yes, I can calculate all the future dividends. All right, so watch me closely. I'm going to do the deep dividend 2010 multiplied by 1 plus the growth rate for 2011. So that's a very simple formula. All right, so that's going to be 62.38 cents per share in 2011. All right, and then I can actually copy this across, so I get all the future dividends. Okay, all right, so now what? We still have this infinite horizon here. So now how do we actually cut this timeline? Okay, if you don't cut this timeline, then you're actually going to run into the same problem as the general dividend discounted model, which is this model is not operational because you're carrying this infinite horizon here. All right, so you're actually trying to work out the summation for a mathematical series. If you don't know the properties of this mathematical series, then you cannot work out the summation result. All right, so the trick or the catch here is apparently the constant dividend growth period in the third stage. All right, so listen up. Okay, when you actually work with non-constant dividend growth model, all that matters is eventually the dividend growth rate should stabilize. Okay, you can actually have, let's say, 100 periods in the future. In the near future, the dividend growth rate could be very erratic, could be very bizarre. But as long as the dividend growth rate stabilizes after some point, then mathematically you can actually work out the summation result for a mathematical series. Okay, of course, using 100 periods in the near future, that is apparently an exaggeration. All right, we can standing at today, we might be able to assume what's going to happen in the next 5 years, or maybe in the next 6 or 7 or 8 or 10. But if you're saying I can actually foresee what's going to happen 100 years from today, I mean, most likely that's bullshit. All right, so we're going to actually look at this nature of this non-constant dividend growth model, and we're going to say, all right, what should we do now? All right, so notice this is a very important observation. All right, the dividend growth rate is not constant for the entire timeline. All right, so you cannot apply the Gordon model. All right, so you cannot apply the Gordon model. Gordon model does not apply. All right, so that is that's just not applicable, not applicable because the assumption is violated. All right, so what should we do here? Well, the dividend growth rate stabilizes starting from year. All right, when is it? All right, well, it's actually starting from year 2019 or period 9. Okay, so that is actually a very interesting starting point. So prior to this point, the growth rate does not stabilize. But starting from period 9 or year 2019, the growth rate actually stabilizes at year at 7%. Okay, so this actually implies we cannot apply the Gordon model to the entire timeline, but we can apply the Gordon model to the partial timeline. And the partial timeline is going to start from, let's say, year 2019. Okay, so if you think of 2019 as quote unquote period 0, then if you ignore all the years from 2010 to 2018, starting from 2019, we're back in the Gordon model world. All right, so can we apply the Gordon model and calculate the stock price in 2019? Well, the answer is of course. You can actually calculate the stock price in 2019. So this actually is equal to, according to the Gordon model says this is equal to the next period dividend, which is this number here, all right, divided by R, which is the 8% here, minus G, which is the, oops, I think I made a mistake here. It's actually going to stabilize at 6%, all right? So I have to, I apologize for, causing this confusion here. And this actually should be 6% for 7 years, all right? So that's 1, 2, 3, 4, 5, 6. Okay, yes, so we need to have one more, all right? And this would be starting from year 6. That would be year, stage 3. Okay. All right. So actually, I should revise my my note here as well. So starting from year 2020, okay, or a period of 10, all right, the growth rate stabilizes. All right, so now back to square one. We have to apply the Gordon model partially starting from year 2020, and so the stock price in year 2020 is going to be equal to the next period of dividend, which is this number here, divided by R, which is 8%, minus G, which is the constant dividend growth rate of 6%. Okay, so I can use the 6% there. All right, so that is the stock price in year 2020. Okay, and a very important observation here, the Gordon model, or I should say, need to look at the next period of dividends. Okay, so in this case, it's actually dividend in year 2021. Dividend in 2021 to get the stock price in 2020. All right. So that is a very important observation. And now, what do we call this? Well, we can actually call this resale price. Okay. Why is that? So now we actually have an interpretation for this resale price now. So initially, we're talking about a Warren Buffett type investor who is actually holding the stock forever. So the investor is going to receive all the future dividends, okay? And the investor is going to discount all these dividends back to today and say, all right, the present value adds up to this much, so that's the price I'm willing to pay for, okay? So now we're actually switching our perspective. All right, we are no longer Warren Buffett type investor. Instead, we are a short-term myopic investor. We are only interested in holding the stock for 10 years. Okay, and at the end of year 10, we're going to sell the stock. And when that happens, when the stock is sold at the end of year 10, how much are you going to cash out? Well, you're going to cash out at $77.07. All right, that's the price at the end of the year 2020. Okay, so that's why we're calling this resale price. All right, so note the interpretation for the resale price. All right, so the short-term investor, sells the stock. Sells the stock. At the end of year 2020 for $77.07. Okay, or 8 cents. All right. So that is, now what we are focusing on. So, consequently, the timeline is now finite. Why? Because we're not talking about a short-term investor. We're not talking about a long-term investor who is holding a stock forever. Instead, we're talking about short-term investor, and this investor is only going to hold the stock for 10 years. All right, so I'm going to copy everything here, and this is only 10 period of timeline now, and I'm going to look at the resale price, and this actually is $77.08. Okay, so that is the the timeline now. Why? Because the investor actually sells the stock at the end of year 10. All right, so let's look at what is the cash flow going into this short-term investor's pocket. All right, cash flow per period. So this actually is equal to these resale price plus the last period of dividend, right? So in year 10, the investor is going to collect the last period of dividend, and then the investor is going to sell the stock. And when that happens, the investor sells it for $77.07. All right. And prior to that, the investor is just going to pick up, the dividends in the first 9 periods. And in the first 9 periods, there is no resale price because the stock is not sold yet. Okay. All right. So that is, of course, reminding you that in this case, we're talking about a multiple cash flow structure now, okay? So if I want to value this particular stock, I just need to get the present value of each cash flow. So I'm going to do the discounting here. This is going back to chapter 2, and we're just going to do, the discounting for each, individual cash flow. All right, so 1 plus the 8%, which is the investor's required rate of return, which is used as the discount rate. All right, so that is the present value of the first dividend or the first period of cash flow. And I can now copy this across to get the present value of the other cash flows. And now I can say present value of all cash flows. So this is going to be the summation of all these present values. Okay, so that is going to be the stock price today for Walgreens. That's $42.28. So this is stock price today, okay, or the stock price for Walgreens in 2010. Now you can actually compare this number to the actual stock price for Walgreens in 2010. All right, I believe Walgreens has gone through some, mergers and acquisitions. So you may have to look up the historical data by Yahoo Finance or some other information source. All right, so this is a very, very important, just to sum up, let me make a few, comments here. All right, so first of all, only consider future dividends. All right, so in this case, I have the dividend in 2010, but it does not enter into my stock valuation number. All right, I'm only looking at the future dividends. Okay, all right. You need to watch out when the dividend growth rate stabilizes. Okay, so you see that in this case the stock price, the dividend growth rate actually stabilizes starting from year 10 or year 2020, and this is when you can actually apply the Gordon model. All right, so you can also apply the Gordon model starting from year 2021 or year 2022, and so on and so forth. All right, why? because the dividend growth rate stabilizes starting from year 2020, so it certainly stabilizes starting from year 2021. So the Gordon model applies. It certainly stabilizes starting from year 2022. So the Gordon model still applies. All right. So you may wonder, well, if that's the case, can I actually get the same stock price? Okay. So here I'm using the the resale price in year 2021 to replicate the stock price today. Okay. All right. So I'm going to actually copy everything we have from the setup here, and this is what we have. All right. So I'm going to copy everything and paste it here. And now I notice that the dividend growth rate actually starts to stabilize in year 2020. So I can look at the resale price in year 2021 by looking at the dividend in 2022. So this is applying the Gordon model. Gordon model says the next period dividend divided by R, which is 8%, minus G, which is 6%. Okay. So the stock price in year 2021 is going to be $81.70. All right. So now the timeline is no longer infinite. It's actually finite. So we just need to worry about the first 11 periods. So I'm going to get the cash flow in the first 11 periods. So in the last period, this is the coupon. Excuse me. This is the resale price plus the last period dividends. All right. So that's 83. And I can copy this across, and now I can actually get, this time, I can actually get present value of all cash flows directly by using the messed up NPV function here. If you guys still remember what we discussed in capital budgeting, the NPV function is messed up, but that's okay. We can still do it as long as you know how this is messed up. NPV Excel function calculates the present value of the future cash flows. Okay, and that's precisely what we need to do. All right, so I'm taking 8% to be the discount rate, and I'm actually looking at all those future cash flows. Okay, and so if I actually press enter, that's $42.28, which is actually the same number you saw earlier. And I can even show a few more decimals just to make sure this actually is, this is actually the case. All right, so that is the the alternative way of getting the price or the present value of all future cash flows. So you see that in this case, you can easily replicate the stock price today by looking at the resale price in 2020. That's fine. The resale price in 2021 or 2022. That's fine too. All right, and also notice the resale price in resale prices are related. Okay, so let me actually elaborate it here. Okay, so in the first iteration, we did the resale price in 2020, and what is that number? The resale price in 2020, that's $77.07. Okay, and let's look at resale price in 2021, and what's that number? That number is actually $81.70. Okay, so these two prices are related. All right, if I want to replicate the resale price in 2021, I can actually do one thing. I can actually look at the resale price in 2020 and multiply that by 6%. Okay, if I do that, I replicate the resale price in 2021. Okay, so look at what I'm doing here. This is essentially saying, over the course of this year, 2021, well, the stock price actually grows at 6%. That's what this is telling us. All right, so if you look at the stock price in 2020, if you multiply that by 1 plus the stock price growth rate of 6%, you get the stock price in 2021 in the Gordon model world. All right, so this is not a surprise because you can actually prove this. Okay, so in the Gordon model world, all right, the G is not only the stock dividend growth rate, it is also the stock price growth rate. Okay, so you can actually think of the stock, price as a tree, and this tree is actually growing every year, and actually the speed at which the tree grows is the same as the constant dividend growth rate. And I have to emphasize, you are in the Gordon model world. Okay, if you're in the Gordon model world, the G actually takes these two hats. All right, so G is wearing two hats. One is the constant stock price growth rate. One is the constant dividend growth rate. All right, so that is my brief comments here, and so in general, okay, that's my third comment here. All right, so in general, to deal with non-constant dividend growth model, okay, just need to follow follow the recipe. All right, follow the steps outlined in the above, which is, first of all, build the timeline. Okay, and secondly, find the dividend and G per period. Okay, and thirdly, all right, calculate all future dividends. All right, I should say find the starting D, find the starting dividend, and and indicate the G per period. Okay, so that's what we did. All right, calculate all future dividends, and watch out. All right, the fourth step is watch out when G stabilizes, so that Gordon model can be applied, and resale price can be calculated. All right, and then the fifth step is focus on the finite timeline, and apply multiple cash flow discounting. Okay. All right, so these are the major steps you might want to follow if you're dealing with a non-constant dividend growth stock. All right, so in general, as I said, all you need is really when the dividend growth rate stabilizes. All right, as long as you have that stabilization, then you can actually finish this equity valuation exercise. Okay. All right, so that is my discussion for this Walgreen example, and I'm just going to deal with another example of the non-constant dividend growth stock, and this actually is getting a little long here, so I'm just going to stop the video and I'm going to make another video. Okay. All right, so I'll stop the recording here.